Welcome, one and all, once again to Kings and Queens Accounting Class. We are here again to share with you in relation to the information company accounts. We have started this topic. In our previous lesson, we have done the introduction to it. We're going to be going a little bit deeper into the concepts relating to the company account, right? And so we want to do a little recap to make sure some essential concepts are understood. Once they are grasped, then I am sure it will make the whole process easier. Now, first thing, when it comes to company accounts, well, the companies have what is called share capital. And their share capital, yes, is in relation to authorized share capital, right? And we have what is referred to as, putting the D, issued share capital. And in our last lesson, we indicated that authorized share capital represents the maximum amount of shares that the company is permitted to use to operate their business. The issued share capital speaks to the actual that amount of shares that were taken up by shareholders. All right? And we spoke last time about private companies and public companies. But we're going to move on. Now, when the company design its total share, yes, and they are going to be distributing it, they distribute it to the shareholders, and the shareholders benefit from the profit. Yes, the shareholders benefit from the profit, and they get monies in terms of monies from the profit in the form of what we call dividends. So the shareholders benefit from the business when the business makes a profit from what we refer to as dividends. They receive what is referred to as dividends. In banks, when you put your money into the bank, the benefit you get is in relation to interest, right? All right, so let's go on. The other point I want for you to recall is in relation to the types of shares. And we talk about preference shares, or they sometimes we call it preferred, yes, and ordinary shares. Ordinary shares. These are two main types of shares that you will find in businesses. All right. Now, preference shares, they are those shareholders who are given first preference in obtaining dividends from out of the profit. Yes, the preference shareholders they are the first one to obtain dividends from the profit. All right. And we spoke last time about the two types of preference shareholders, the accumulative preference shareholder and the non-cumulative, right? Cumulative means that whatever is not paid in 1 year, it will be added into the other year and paid to the shareholder. The non-cumulative preference share represents those shares that are over the period. If it is not paid in the current accounting period, then it will not be paid in the following or succeeding accounting period. All right, so it's non-cumulative. So we're referring to preference shares, right? And one very important point is that preference shares are normally quoted with a percentage. So it's a pre-designed percentage. So they are paid a fixed percentage. Yes, they are paid a fixed percentage or percentage rate. Okay, so that is the matter in relation to preference share. The ordinary shareholders now are paid dividends, yes, from the profit that is left and available to be distributed. All right. Okay. Now there is one other idea about shares I want to bring to your attention, and that is bonus shares. Now this concept of bonus share, I just want to introduce it here, that bonus shares are really shares referred to, right? That the company or the directors decides instead of paying out dividends, yes, they are going to recapitalize the company by issuing to the current or the existing shareholders additional shares. And the shareholders does not have to pay, right? They don't have to pay any additional monies. So for example, they are giving bonus shares. It may be, let us say, for every 4 shares, you get 1 bonus share, right? For every 1 share, you get one. Every 4 shares, you get 1 bonus share. So it is a means of, as I said, recapitalizing the business. And sometimes the directors, instead of paying out the money, yes, they are giving the existing shareholders a greater stake of the ownership of the company. That is in relation to bonus shares. All right. The other point now we want to look at quickly, and that has to do with the reserves. So we have what is called there are 2 types of reserves, as we indicated last time. We have capital reserve, and capital reserve, or an example of capital reserve is let us call it's called asset replacement reserve, right? So that's an example of capital reserve. And we say it is capital reserve because what the company is doing is setting aside monies. They are setting aside monies in order to replace an asset when the time comes for it to be taken out, right? All right. And then we have what is called revenue reserve. Now, revenue reserve, I have an example. 1, your retained profit is a revenue reserve. 2, your general reserve. 3, you have what is called foreign exchange reserve, right? And 4, share premium reserve, right? These are examples of revenue reserve. Foreign exchange reserve, the company may be buying goods from overseas or from other countries and need to have enough resources or enough monies set aside so that when they are going to make their purchases on the next batch of goods, they would have enough currency to do so. Share premium reserve, if the company offered certain amount of shares, and a share premium occurs if the par value of the share is, let us say, par value of the share is $2 for each. Yes, or the real value or par value is $2, and when you put the share out there to be sold, yes, it is being sold for, let us say, $5. Sold for $5, then the premium would have been $3, right? It would be $3. So you'd have benefited or profited from the sale of the share. All right. So that is in relation to the different types of reserve. I want to move on now quickly to look at how do we calculate now the dividends for the various types of shareholders. So, ladies and gentlemen, we have indicated that we're going to be looking at the calculation of dividends, right? We're going to look at how this is done. So, now we said earlier that preference shares, it's always quoted with the percentage. So let us say it's a 5%, right? Preference share. And the value of the shares amounts to, let us say, $20,000, right? And the ordinary shares amounts to $50,000. Now, what will happen is, if we're going to be calculating the dividend at the end of the year for these shareholders, we know right away that this quotation, this 5%, represents the 5% dividends that they will be paid. All the preference shareholders will be paid 5% preference share for dividends. However, each year the directors will indicate the percentage that will be paid to the ordinary shareholders. Let us say that is 10%, yes? So if we're going to be calculating now the preference share dividends, yes? It would be 5%, which is 5 over 100 times 20,000, right? And that would give us 5% of that would be $1,000. So each shareholder will be getting $1,000. Yes, that's the total amount that is going to be paid out to the shareholders, $1,000. Now for the ordinary shares, for the dividends for the ordinary share, we're going to find 10% of the 50,000. 10% of the 50,000. So it's 10 over 100 times 50,000. All right, over 1. And the 10% would represent $5,000. All right. So that is the calculation. So the dividends that will be paid out for preference shareholders would be $1,000, and the dividends paid out for the ordinary shareholders would be $5,000. All right. There is a matter though. Let us say they did not give to us the information in relation to dollars, but they said that the shares is really 2,000 shares at, let us say, $2 each, right? And this is 3,000 shares at $2 each. $2 each, right? So then what we would do in this instance, the first thing that we'll do is that we're going to find out the money value. So we're going to go multiply the 2, so it's going to be 2,000, yes, times 2, and that is going to give us what now? 4,000, yes? And then we are going to find the 5% of the 4,000. Which is going to be, 5% of that is going to be 2,000. 200. Yes? Yes. And in this event, we multiply that. It's going to be 3,000 times 2. And that is going to give us what now? 6,000 times 10. And that is going to be 600. Right? That's the idea in terms of when they have given to you the not the monetary value, but the number of shares, right? The number of shares, and you're going to be finding the value of the shares. Then you'll find the percentage in relation to the amount of dividends that will be paid. All right. Our next move I want us to quickly go at is looking at corporation tax, the deduction, making deductions. So deduction of tax. Now, every company or all companies are required to pay corporation tax. All right. So the corporation tax is deducted, right, from the net profit. So after we have obtained our net profit, let us say for argument's sake our net profit is $50,000. Yes. And we are going to subtract the corporation tax, and let us say the corporation tax is 8,000. Then we're going to subtract it. So this would be now the profit after tax, right? And then what we will do now is to now introduce the retained profit. And this retained profit now would have been the one coming from the one that is brought down, one coming from the previous year. All right. And let us say that is the retained profit was 20,000. So it would have been, the total would be 62,000. All right. I just want us to be able to understand in terms of relating to corporation tax. All right. So the deduction is made after we have found our net profit. Okay. All right. So now we have two examples here, and we're going to proceed quickly in working these two exercises. In the first instance, it tells us that Cook Limited authorized share capital is $200,000. Dividends, it is divided into 150,000 ordinary shares. This is not 100. It should be 2,000, not in dollars. It is 200,000 shares, yes, and it is divided into 150,000 ordinary shares at $1 each, and 50,000, yes, shares at 8% preference share, right? All the ordinary shares were fully issued and paid. That means all of what the company had required of the shareholders to pay, they have paid up. They paid up all the monies. All right? And they say only 20,000 preference shares were issued. So we are to calculate the shareholders' dividends when ordinary shares are paid at 20% for dividend. All right? So now we are going to work out the dividends for this company, Cook Limited. All right? So let's go. The preference shares were indicated it's an 8% preference share. Yes. 8% preference share, and the total of the preference share that was issued would have been 20,000, right? And so 20,000 at $1 each would have been still, so it's 20,000, right? At $1, which would be a total of $20,000. So the amount of money paid up would have been $20,000. All right. And we're going to be determining now, calculate for the preference shareholder their dividends. So their dividends would be, it would be 8%, so 8 over 100 times 20, right, over 1. And that now we will calculate to determine what now? The preference share dividends. All right, for 8%. 8%. Now, for the second, the ordinary shareholders, they indicate that it is 20%. So it is 20% for the ordinary shareholders. Ordinary shares. Excuse me. Ordinary shares, 20%. And the total amount of shares that they had was 150,000 at $1 each. So the total amount of money then would have been 150,000. All right. So to determine the dividends now, it would be what now? 10%, which is that over 1,500. All right. And once you work this out, you will be getting the total amount of dividends required to be paid to the shareholders. So when we do the calculation, we are getting 1,600. Yes, that would be the dividends. $1,600 would be the dividends being paid to the preference shareholders. And if we do the calculation for this, for the ordinary shareholders, we're getting a $15,000, yes, for the dividends paid to the ordinary shareholders. All right, so that would have completed the whole idea of calculating. Oh, I'm sorry, my word. Please forgive me. It is 20%, not 10%. Oh, Lord, it is very important that we read carefully. Huh? It's not, it would have been 20%. They did say it is 20%. All right, so 20% of this then would be $30,000. Right? So the ordinary shares would have been $30,000. Dividends rather would have been $30,000, and for the preference shares it would be $1,600 for that. All right? Yes, for that. Right. So now let's go to this question. The second one. Let's quickly do the second question. Apple Company in 2018 made a net profit before taxation of $235,000 for the year ended December 31st. Retained profit as at 2017 is 17,000. General reserve to be transferred is 30,000. To be transferred for foreign exchange reserve is 5,000. Goodwill to be written off is 11,000. And ordinary share capital is $500,000 at $2 each, and dividends at a rate of 10%. There's a 10% preference share capital of 250 shares at $1 each. All right, and now we're going to be doing the appropriation account. So let's proceed with that activity. So it is the profit and loss appropriation account. All right. I always like to use 3 columns so that we can do all the necessary adjustments. All right. So now we'll proceed to start with the net profit. And we're doing this appropriation account for 2018. So the net profit is going to be introduced now. And the net profit in the question is 200, yes, and 35,000. And they indicated to us that this was before taxation, or before the tax. And the question, yes, before taxation. So we are going to be taking out the taxation amount, the tax amount. Well, we're going to be taking out the tax, and the corporation tax is $25,000. $25,000. So we're going to less the corporation tax of 25,000, and so the retained profit, it would be, new retained profit would be now what? 200, yes, 210,000. Right? This is the profit after tax. All right? So then we are going to add now our retained profit, and this represents now retained profit coming from the following year, and they have indicated it is $17,000. So we can put that in, $17,000. When we add them, we're going to get $227,000. All right, so now we have taken account of the deduction of the tax, and we have added the retained profit. So in the company, the total amount of profit that they have for allocation would have been $227,000. All right, we're now going to make in the deductions. So the first thing we are going to do is that we're going to remove, we're writing off goodwill. So we're going to less it now. All right, write off the goodwill. So we're going to do that. They indicate that goodwill is to be written off, 11,000. So we're going to make a deduction from the profit in terms of the goodwill. Then we're going to also make transfers, right? So we're going to deal with the reserves now, right? So we have general reserve, And the general reserve they indicated was $30,000. And we also have a foreign exchange reserve. And the foreign exchange is 5,000. So the total amount of reserves we're setting aside from our profit would be $35,000. Okay? Our next move is to allocate now and pay out the dividends. So now we're going to less our dividends. And the dividends in relation to our 10%, because the first set of shareholders we're dealing with is the preference shares. So 10%. 10% is preference share. Okay. All right. To do that, we must find 10%. Well, the value would have been $25,000. Sorry, $250,000. Have my excuse. Because multiplying 1 times that is going to give you remaining. So times 10% of that, 250,000. And we're looking at 25,000. So the ordinary shareholders would be receiving $25,000. All right. Then we're going to our ordinary shareholders. Sorry, the preference shareholder receiving $25,000. And then our ordinary shareholders. Now the ordinary shareholders are paid this year 10% as well, right? They are paid 10%. All right. So it would have been right 1 million multiply the 500,000 shares times 2, and that will give us $1 million. $1 million. Yes, times the 10%. All right. Okay, so that looks to me like what now? 100,000? Yes, $100,000. So they are getting $100,000. When we add this together, we will be having what now? 125,000. We're going to total these three and then subtract it from that.